Hello and welcome back to our Brighter Minds weekly meet. Uh, we will wait for a few minutes, then we'll start the session for today. So let's start the session. In today's meeting, we will discuss about the various things that has happened in past few days and how our portfolio get one if one makes one portfolio, how he should be aligned or how he should be positioned himself for the any kind of recovery or any kind of long term value that is on the table that he should invest for keeping 2 3 4 5 years in mind. Let's start from the global market first. So obviously, over the weekend, yesterday was U.S. market closer, and we do not have global cues from U.S. market. So other than that, European markets has been quite mixed. Germany and UK was positive. Germany was a bit down, and from Asian markets, we also getting positive cues, positive signals that Nikkei and Hang Seng both both are trading in positive territory. So that is the global cue from global markets. And from today, uh, other than that, few developments has happened. The number one is US is going to uh, you know take consideration of the Chinese tariff on this week. Obviously, news articles are there that President Biden will consider this in this week itself, and that will obviously put huge relief to U.S. inflation's number that has been quite a headache for the U.S. central bank, Fed. And obviously, we are into July, and they have their MPC meet, their FOMC meet on 27th of July. So that will guide us more through the future pathways of the Fed. And from July meet, we will have another meet in September. So in these two meets, the market expectations, obviously everybody knew that market is expecting 75 bips in this meet and 50 bips in September meet. So that is quite known to the market. Any kind of lesser or positive outlook or any kind of positive comments from Fed will obviously cheer the market, as we all know, because most of the bearishness has been factored into the price of the U.S. market also. And the second thing that has happened over the weekend is that obviously we all know that Russian President Putin has congratulated their army troops and all, that they were saying that they have freed the Luhansk region of Ukraine. So obviously we also know that from various media articles that has been the public domain that Russia is in commanding position in Ukraine, and obviously Ukraine possibility of winning the war or any kind of upper hand is getting diminished day by day, and obviously we will get some sort of news sooner than later. And that obviously every geopolitical events has their own sweet timelines. So. this event has already been dragged from February 24th till now. So, an European energy crisis due to this war has been a headache for many European nations, and they are trying to bring those two parties, Russia and Ukraine, on the table, and you know, are trying to convince them that please sit down on the table and negotiate whatever you want to do, and whatever is in your own interest, please do. But the war has been already dragged, so there should be some solution or sort of. So that was the second update, and the third was that we all know that China has been opened after COVID lockdowns. So ports are quite busy in China. Obviously, trade is on the path of normalization. So there is going to be a huge supply in the global market from Chinese port, and that will put deflationary pressure on many commodities, right? Because supply chain was also an outcome of Russia-Ukraine war that has accentuated those problems. Before that, China's COVID lockdown was there, but Russia-Ukraine was really, exacerbate this problem. So in that case, once the supply gets normalized, you will see that many commodity prices will fall further. And we obviously have seen in past few days or in last month that many commodities prices have hit their peak, and they are correcting from those higher levels. And obviously there is substantial correction in most of the commodities. We obviously segregate commodities in various parts like metals, ferrous metal and non-ferrous industrial metals, and then there is agro commodities, then there is energy. Obviously, we have seen the corrections in agro part also, and we have seen there has been massive correction in ferrous and non-ferrous metals. Even in industrial metal, we have seen copper correcting quite hugely, and there is also a correction in aluminum. So these are industrial metals, and they have all corrected. The only commodity that is still being strong is energy, and obviously that is crude oil. And since being a largest importer of crude oil, India imports most of the crude, roughly 85% of the crude. So that is a pain point for India, but that is also temporary because we all know that most of the commodities has corrected substantially, and obviously the is uh, crude will get softened once the Europe or US energy crisis will normalize, and this will get normalized with the any kind of positive news from Russia Ukraine war. So that is the second part. Um, Third part, obviously, we have discussed the second part, and third part is China opening up of their ports and all sort of things, so putting pressure on the supply chain, putting pressure on the commodity prices, and normalizing the supply chain. So that these things are positive in nature. Obviously, first one was positive in nature for US inflation point of view, uh, and second one, that Russia Ukraine war, as we discussed, is positive from commodities prices point of view. And third part of China's opening up their economy is also positive from supply chain and commodities point of view. Uh, so these are the three things that has came over the weekends, and that is obviously positive for global equities market. And now we will discuss about Indian markets and Indian macros and all sort of things. So obviously, crude is sticky right now. Obviously, hovering around more than $110 per barrel. Obviously, RBI has made their assumptions in this MPC meet that has gone by in in June. They have taken the assumption of 110 dollar per barrel. So that is quite factored into the inflation number that RBI has projected for FY23. And if any kind of relief comes on crude front, obviously that is positive for India. Crude has been sticky due to various supply reasons. Sometimes Libya issue, and sometimes underproduction, or there is no additional capacity left with OPEC and sort of things. So whenever that get normalized, obviously India is going to be one of the biggest beneficiary, because that is putting quite a pressure on Indian fiscal deficit and trade deficit and all sort of things. So Indian macro will obviously, as we say that we are towards the peak pain. Obviously, we can say that might be we are not right now, but going ahead, we might be at looking at peak pain in next 2 to 3 months. So one that was one part. The second one was that in India's trade deficit has been obviously widened, and that is the reason uh, that things are getting accelerated by ministries. And we have heard that finance ministry and RBI are both together doing things so that the inflation issue and these factors like fiscal deficit and will remain in control. So whenever we see that, whenever central bank and any country's central bank and government are in sync, things will get normalized over a period of time sooner than later. So that is also a positive part from Indian government and RBI side. Then there is one factor that we all were looking, and that is earning season for June, because everybody knew that commodities prices have been inflated in June quarter. So everybody wants to look at how the margin has been factor in playing out in this quarter, and what is the commentary of the management for future outlook. So these things will be looked at very minutely. So obviously, some flash results have come in past few days, and we all can see that there is good numbers, and obviously from revenue point of view, there are some part of inflation contribution in there. Uh, we have seen the DMarts, sales flash result. We have seen the HDFC Bank flash result. We have seen you know IDFC Bank flash number. We have seen these are the companies that have delivered their flash result few days back. And obviously our HDFC Bank has been a strong, and if you see their loan book growth, obviously that is quite a stronger. So there is one trend that can emanate from these, macro conditions, macro challenges in India itself, that market will shift to those players that are capable, that have strong, balance sheet, that have strong market leadership position. They will capture the market share from the weaker players, because that in this high inflationary times, high interest rate regime, obviously they will lose some market share, because their cost of fund will going to be up, and obviously uh, competing with larger players and players with scales and scale benefit or cost advantages is going to be difficult for a stronger player. So these obviously changes goes to the quality companies. So in this quarter, we will look at those quality companies, and we should look at those quality companies that can capture the market share from the weaker players, and those are going to be the winners in the future. So that is from India side. The second thing is that obviously commodity Spain has been into various sectors like specialty chemicals, steel, metal, and all sort of sectors that are dependent on crude or metals and palm oils like FMCG. This sector will get a relief, and obviously we are hoping that management guidance and outlook uh, comes more positive than last quarter, and that will obviously help the Nifty TPS. And we all know that earnings drive the long-term value for any investment, and cash earning and cash flow. So if the long-term trajectory of the company or long-term commentary from the management comes good, obviously these are the times when we should build a quality portfolio, because India has seen substantial corrections in many across the market cap, small cap, mid cap, large cap. Everyone has been beaten to the blue. So larger pain is into the small cap and mid cap space, and that is obviously the reason behind that was many have some working capital issues, many have supply chain issues, and obviously we know that few possess the mode to have so much of valuations that they were trading at. So in that case, since valuation has normalized, corrected sharply from the high levels that we have seen, these are the good times when one should look at building the portfolio. One should look at quality companies. One should look at companies that are debt free. Uh, Obviously, cash rich companies, debt free companies, companies with market leadership positions, companies that are gaining the market share. And obviously one should look at building these, because we don't know that when the peak pain of macro is going to happen. Obviously we are close to that, but nobody can predict the exact timing of the peak pain. And we all know that whenever there is clarity on things, that over a period of 2 3 months or 4 months 5 months we are going to see peak pain, market will obviously bottom out before that. Market thinks at least 3 to 6 months ahead of the things that happen on the ground. So in that case, whenever market sense that it is going to be peak in energy prices, is especially, and the Indian market will also bottom out, because that is one pain point for India. The second pain point one look at is obviously the bond yields, US bond yields. And we have all seen that US bond yield has corrected sharply from higher levels, obviously 3.4 level to 2.8 we have seen in past few days. So that is a relief for bond markets, particularly from Indian context. So foreign money has been flowing out. Due to that, they are putting their money into the those investments that are quite safer from, once they are pulling from emerging markets, and that is going down in last week. So that is also a positive point for Indian market and emerging market particularly. There is one another point that is that has been a pain point till now, is dollar index, and dollar index is trading above 105. So whenever we know that a dollar is offering these kind of returns, and obviously there is flight of safety for any fund or capital, dollar offer so much value for them, so they will go there. Once that dollar index starts softening or start picking out, obviously the positioning of FIs will again change to the towards the emerging market. And we all know that India is one of the largest uh, largest and strongest contender of uh, getting those money pulled in to their nation, because we all know that India offers more than 7% plus growth, and that is there. And we all know that there is huge potential that India can unlock from their manufacturing, their manufacturing schemes, PLI, and all sort of things. Obviously, one part of that is Indian IT companies that has been, they benefit from the rupees weakening, but there is problem in their core markets from orders point of view. Last quarter, they have given the outlook that there is no problem and there is no worry point. But it is very important to look at their commentary in this quarter. They will show us better that what's happening in the US from recession point of view. So we will know better from uh, those businesses, because they are into those businesses and doing this business there. So they are well informed. So these are the things that we have we thought that we should discuss and share with better mind. You know, uh, so that's all from my side, from market perspective, from uh, global market perspective, from global variables macro perspective, and from Indian market perspective. So if there is any question, I will surely take it up and try to answer those as quickly as we can. So we will wait for a few minutes, then we proceed further. Thank you. Okay. So thank you for today, and we hope that we will meet in the next week at the same time. Thank you. Thank you all.